All right, let's get right into it. Today, we're unpacking a really fascinating player in the UK tech space, Softcat PLC. If you've been following IT infrastructure, you know these guys are basically dominating the current landscape. We're going to look at exactly how a modern tech reseller manages to combine a flawless balance sheet with just explosive top-line momentum. So the tone for Softcat's entire year, it was actually set straight from the top. CEO Graham Charlton chose one word for the year: drive. And look, I know that sounds like typical corporate speak, but here it actually reflects some very real, very aggressive forward momentum. They're basically drawing a line in the sand, saying they're determined to press forward, invest, and modernize to stay right at the absolute pinnacle of their industry. And when we say drive, well, this is exactly the kind of momentum we're talking about: 51.5%. That is their phenomenal revenue jump for fiscal year 2025, hitting a staggering £1.45 billion. I mean, in a mature IT market, posting over 50% top-line growth is absolutely the kind of metric that makes you stop scrolling and pay attention. Here's the quick roadmap for today's explainer. We'll cover the meaning of drive, Softcat's winning strategy, their exceptional financial performance, capital allocation, and finally, their current market valuation. Starting with Section 1, the meaning of drive and how they're fueling innovation. So, drive isn't just a buzzword for Softcat, it's really an institutional commitment that's just woven right into the fabric of the company. It's about navigating this incredibly fast, complex tech landscape, but, and this is key, without losing sight of their core mission. They're totally dedicated to investing in innovation, delivering exceptional outcomes for clients, growing sustainably, and, crucially, empowering their employees. It's this holistic approach, balancing human capital with hard technological advancement. Moving on to Section 2, Softcat's winning strategy, basically their growth engine. Now, what's really fascinating here is how they balance this super aggressive financial model with their actual company culture. Check this out. They maintain an incredible 98% customer satisfaction score, which, let's be real, is practically unheard of at this scale. And they pair that with an 88% employee engagement score. Their whole stated purpose is actually to help customers succeed by putting employees first. It's a complete virtuous cycle, right? Happy employees naturally create intensely loyal customers. And their overarching strategy? It's beautifully simple but highly effective. It's just a two-pronged approach: sell more to existing customers and acquire new ones. Sounds basic, I know, but execution is literally everything. By staying relevant, being super easy to do business with, and constantly expanding their digital platforms, they've organically grown their customer base to over 10,400 corporate and public sector clients as of early 2026, which builds directly into how they're future-proofing themselves. So Softcat is famous for organic growth, right? But they recently made a huge landmark move, acquiring the Oakland Group. This is actually the first acquisition in their entire history. It's a highly strategic capability bolt-on designed specifically to capture those accelerating data and AI tailwinds. Because, let's face it, you can't deliver AI solutions without killer data architecture, and Oakland gives them exactly that muscle. All right, Section 3, exceptional financial performance. Let's check the scoreboard. Just look at this leap in gross profit. We're seeing it jump from £417.8 million in FY24 up to £494.3 million in FY25. That's an 18.3% increase. And you might be wondering, why focus on gross profit here? Well, in the reseller business, top-line revenue can bounce around depending on the mix of hardware versus software. But gross profit, that proves the underlying customer proposition is actually highly profitable and scaling beautifully. And no surprise, they didn't stop there. This momentum carried right over into the first half of fiscal year 2026. Gross profit surged another 22.6% year over year, and underlying operating profit just skyrocketed by 27.3%. This level of outperformance, across all their technologies and customer groups, absolutely smashed market expectations. It was so strong, management actually had to upgrade their full-year profit guidance. And this brilliantly illustrates the sheer cash-generative power of their business model. They ended the first half of 2026 sitting on a massive £206 million in cash and cash equivalents, up from $141 million the year prior. Think about that. In a world currently full of macroeconomic headaches and heavy corporate leverage, Softcat is basically a fortress. They have literally never issued any debt securities, zero. Let's move to Section 4, capital allocation and returns, and how they reward shareholders. So what exactly do they do with all that cash? Well, management follows a very strict four-step framework. Priority 1 is always investing for long-term organic growth, meaning adding headcount, upgrading systems, boosting digital capability. Priority 2 is maintaining a progressive ordinary dividend, usually paying out 40 to 50% of profits. Priority 3 gives them room for compelling strategic bolt-ons, like the Oakland deal we just talked about. And finally, priority 4, if there's any excess cash left over, they aggressively return it right back to shareholders. A perfect example of that fourth priority in action is their recent share buyback program. They announced a £45 million program on January 8, 2026. By the end of January, they'd already executed almost 25 million of it. And by February 13th, the entire thing was done. They bought back and canceled over 3.3 million shares in just over a month. Talk about a ruthless, efficient return of capital. Which brings us to Section 5, Current Market Valuation, looking at the market reality. Softcat trades on the London Stock Exchange under the ticker SCT. So let's take a look at exactly how the market is digesting this massive cash generation, the debt-free balance sheet, and those market-leading margins as of May 2026. So the crucial point here is the contrast between their incredible profitability and their current price. Softcat is generating a jaw-dropping 52.3% return on equity. But despite that insane profitability, it's currently trading at a price-to-earnings ratio of just 18.55. Now, historically, its median PE is over 25. Throw in a really healthy 3.24% free cash flow yield, and you're looking at a highly profitable market leader that's actually trading below its historical average multiples. And you have to remember, this valuation sits right against a backdrop of massive industry tailwinds. The rapid adoption of AI is fundamentally accelerating the demand for IT infrastructure, data storage, cybersecurity, consulting, the whole shebang. Every single business right now needs to modernize just to survive the AI revolution, and Softcat is perfectly positioned as that trusted partner to guide them through it. Which leaves us with a final thought to ponder. They've got a flawless, debt-free balance sheet. They've just integrated a specialist data team to heavily capitalize on AI. And they have this unmatched culture of employee engagement that just heavily drives customer loyalty. So, with all that in place, how will Softcat's intense drive shape their trajectory over the next decade? It's a genuinely fascinating question for any serious student of the markets. Thanks so much for joining me for this explainer. I hope this deep dive brought the mechanics of Softcat's success clearly into focus.